Studio. We're pleased to welcome now Jeremy Nelson, partner at Element Wealth. Hey, Jeremy.
Glad to be here, Gerard.
Yeah, so I didn't have what has happened in the markets the last few days on my bingo card for this year.
Yeah, I would have not expected the rapid waterfall 20% decline, right? I mean, it's been pretty interesting. I mean, obviously, we kind of anticipated that equities could be a little bit weak this year. That was kind of the theme of our economic forecast that we did. But, I mean, when you see sweeping tariffs across 180 countries and territories, you know, the market's going to react pretty negatively to that.
And I wonder about that, Jeremy, and here's why. When you look at the country's GDP at, 31, 32 trillion, and you got total imports at 3 and an imbalance of about 1, it seems like we're overreacting. What am I missing there?
Well, one, it can be inflationary. Because the question, it can be inflationary or it's going to hit corporate profits, right? Because you're not going to right-size the trade deficit overnight because you can't create all of the manufacturing and everything overnight. So
I'm not sure we ever will.
Yeah, I don't think we will.
Yeah.
But so you don't have the supply set up. So that tariff is a tax, right? And so either the corporations that are importing the goods are going to eat it, or the consumer is going to eat it. So it's either inflationary or it's hitting corporate profits.
Yeah. I guess the only point I'm trying to make is we still have a large swath of GDP. Now, I know a big chunk of that's government, unfortunately, that's not affected, that's unaffected. So and then we also got, as a result of recession fears mainly, we got the price of oil coming down. Would that be an offset potentially?
Well, potentially, right? But I think what you're seeing more than anything is you had a market that was expensive, right? We've talked about this for a while, how, like, if you look at PE ratios, if you look at household ownership of stocks, if you looked at sentiment going into this year, there was no way that you could look at the market and say, hey, this is a really cheap stock market. So there was a premium being paid. Well, now you have uncertainty. When you have uncertainty, what ends up happening is that risk premium, that premium that we're paying for stocks just ends up getting sucked out, right? People kind of say, hey, I'm not as willing to take risk right now. We're going to pull it back.
Yeah. So here's something that's kind of crossed my mind the last couple of days. The president told us on the campaign trail that he was going to do this, that he was going to embark on very aggressive trade renegotiation and trade policy. The market still ran up. You would think that more savvy investors would have played the shorts on that. What happened?
Well, I don't think that people expected it to be this extreme.
Okay.
Right. I mean, when you look at the levels, right, and then you look at how they calculated what the tariffs are. I mean, those aren't the actual tariffs, right? I mean, the estimate on actual European tariffs on all U.S. goods going into the EU is 2.7%.
Yeah.
Right. And so it's just not. It's nowhere near the level that they're saying that the tariffs are, or that these trade barriers are.
And that's something that you've seen. There are a lot of folks out there that are big Trump supporters that can't let go from Home Depot. He really was highly critical of the calculation.
Yeah.
And has been verbal in pointing that out.
And look, I think that tariffs to some degree, right, can be good in restoring competitive balance, right? But when you go this far on everybody, especially, you know, countries that we already have free trade agreements with, where there really aren't tariffs going back and forth, then that just starts to create reciprocal tariffs, right? That's the other reason the market sells off, right? I mean, look at what China's saying. I mean, China came back and said, okay, we're going to hit you with 37%. And then, you know, Trump says, well, we're going to hit you with over 100 now. And then China says, like, we're in this till the end.
Yeah.
Well, now you're kind of at this standoff, and nobody really wins, right? I mean, so when you go into a negotiation that's basically a brawl, it doesn't leave investors overly confident.
would you agree that just the fact that there just is no clarity at this point, one way or another, is the biggest issue?
Markets don't like uncertainty.
Yeah.
And
neither do businesses.
Yeah, and what you're seeing now from CEOs and CFOs is that they're really kind of pulling back, right?
Yeah.
Forward guidance. They're saying, look, we really don't know. That slows down hiring, right? Because you're not going to go hire a bunch of people and try to expand your business when you don't know what the landscape is going to look like.
Yeah. Well, so it feels to me like, though, that all of these possible concessions that we're hearing out of the EU, and I mean, like yesterday it was reported that Zimbabwe is set to become the first country to just negotiate a new deal where they eliminate tariffs on American goods. I just don't think that moves the needle, Zimbabwe. I think China is what moves the needle.
Zimbabwe doesn't move the needle. Obviously our biggest trading partners are the EU, Canada, Mexico.
Yeah, and there's very little affecting Canada and Mexico as part of this deal.
Well, I mean, he's still got the 25%, right?
Yeah.
And
from a couple of weeks ago.
Yeah. But they were not a part of the reciprocal tariffs,
okay.
right? They were just part of the original.
That was announced last Wednesday.
Yeah.
But there were some goods, I think, that were even exempt from that, right? That were part of the agreement that he struck back in his first term.
It was only like 10% on Canadian oil and stuff like that. Okay. I think, obviously, the fentanyl thing with the Canadian border, that's not really a national security thing. Mexico, I mean, I think you can make a very strong argument there. I mean, that's where the drugs are coming from.
No doubt.
But the thing is, what really bothered President Trump, and to a certain degree rightfully so, he felt like China and other specifically was kind of backdooring some of the tariffs coming through Mexico.
Okay. And as well as supplying the fentanyl that was flowing through Mexico as well.
Yep.
It was argued. Of course, it's also been speculated that China's like laundering their products through Vietnam.
And that was another one that came out, right?
Taiwan.
And I think it was Vietnam that came out and said, hey, we'll go zero. And they're like, no, because you've got to stop this.
And now you're hearing rumblings of Korea, North Korea, China, Vietnam, even Japan coalescing around some agreements to fight back against this country.
Well, I mean, and it's more than just that. I mean, you're seeing the EU kind of banding together. Yeah. You're seeing the Canadians negotiating with Japan and other countries to try to get more exports going that way. I do think that the longer-term risk here is that essentially the post-World War II world that the U.S. put back together, right? We were the trusted broker that put the world back together. We were and still are the reserve currency, but these other countries are kind of backing away a little bit now, going, hey, maybe we need to start being less reliant on the U.S. And I don't know that that's necessarily great for us in the intermediate term.
Yeah, I wonder that as well. So to those that are looking at their accounts, and the folks that I'm most concerned about are people who are retired, that have accounts they're relying on to carry them for the rest of their lives, and then folks that are approaching retirement, and it just depends on how they got their accounts allocated, asset-wise.
Yeah. I mean, that's why we talk to people about this idea of the risk tolerance, right? What is your risk tolerance? And, what we saw in 2024 was a rapid change in attitude towards risk. People were much more willing to take it. And we were kind of very hesitant. We'd say, whoa, you need to slow down because remember these other times. How did you feel then? What did you do? Oh, well, I panicked and sold. Okay, well, then that portfolio is too risky for you. Yeah. If you look at a diversified portfolio this year, it's actually holding up pretty good. It's down like 5% maybe.
Yeah.
That's not bad.
Yeah.
All things considered.
It just depends on your exposure on the equity side, I would think, and where those are. Something else, and we talk about, if you could say on the other side of the break, is just the difference between when markets retreat that are just part of natural economic factors and cycles versus sort of self-imposed like this, which is what COVID and this was. We get your thoughts on that on the other side of the break. Jeremy Nelson, partner at Element Wealth, is in the Element Wealth studio. We're visiting with Jeremy Nelson, partner at Element Wealth. So before we went to break, Jeremy, and get your thoughts on this, I was just thinking about situations with respect to recovery. So we've lost a lot of wealth. We've seen the markets get pummeled. No secret about that the last few days. Got a little reprieve today, a little recovery in process today. Who knows where this thing closes? And we'll all be focused on the last few minutes if we got buying or selling into the close. Right?
Yeah, I mean, I think I was just talking with a client before I came in here, and I was like, look, I think retail money's flooding in right now. Seeing this, we saw a 20% correction. There was kind of a flood. There was a little bit of algorithmic trading coming in. It's going to be interesting to see what the institutional money does at the close here. Does it bid it back up, or does it start to kind of fade this rally that we're having today?
And so my thoughts are, when you have a sell-off that we've experienced that is kind of self-induced. I mean, there weren't any technicals or fundamentals. It was a fiscal policy, essentially, that came out of the White House that caused this sell-off. Are recoveries in that situation, and my research says that they are, more rapid, the time frame to recover from that sell-off takes place over a shorter period of time than when it's just organic. We got just bad technicals, bad fundamentals, economic contraction, sell-off before we see it return. The situation here, do you think?
Yeah, so I think what you would historically see is if this is a non-recessionary bear market. So let's just say all this trade stuff kind of sorts itself out relatively quickly. We don't go into a recession. I think you'll see the market, pushing back up towards highs maybe this year. I think everyone, Goldman Sachs and all the big banks are cutting their estimates for the year.
Yeah.
Ned Davis research that we follow just came out at about 5,500 at the end of the year. It's kind of their target now. So I think what you typically...
S&P.
Yeah. S&P 500, yep. So typically speaking, if it is a non-recessionary bear market, then it's going to bounce back pretty quick. And those typically are about 20% declines.
Okay.
Now, if it turns into a recessionary bear market, then the average decline there is closer to 35%, historically speaking, which would mean we've got a little bit more to go. So, again, the question becomes the economic damage, how long this lasts. In the short run, I think what I would be looking at and what I would be telling people is when you get waterfall declines like this, right? So when you get these big sell-offs, typically what will happen is you'll get a massively oversold market, right? Check the box. We got there Friday. Market was massively oversold. Then you're going to get a relief rally because some buyers are going to come in. It's going to bid things up, right? That was kind of the turn we saw yesterday. We're seeing a little follow-through here today. But generally speaking, you're going to have a retest of that. And if that retest doesn't hold, right, and it breaks through, you got to start the process again. If it holds, you'll get a breadth thrust where you get a lot of strength in the market, and that's kind of you're all clear, like, okay, we're past this.
The time frames that I heard from an analyst this morning is generally speaking a year and 7 months. When it's due to a recession or a contraction or other economic conditions.
17 months.
17 months, okay.
Yep.
But 5 to 6. Well, like COVID was an example. I mean, it was kind of self-imposed. We sent everybody home, shut the economy down.
Yeah, COVID was a little bit of a weird one, though, because when those stimmy checks started coming and people couldn't spend, they started gambling.
Yeah,
right?
That's true.
And so it was a really weird one because we were actually in a recession, right? And all of a sudden, there was just all this flood into the market. You saw a lot of craziness in some of the high-flying stocks.
So you were talking about retail investing, and there's some inflow of funds from retail investors into the market. Well, Reuters reported that Friday we experienced the biggest investment from the retail investor community that we have in 10 years, in a decade. And it was $4.8 billion.
Yeah.
Well, the market's $62 trillion. So while I get it, retail investors are saying, man, this thing is really low. Everything's on sale. I'm going to jump in. I mean, when you got NVIDIA trading for less than the S&P average, I think.
Yep.
So that's pretty good buying opportunity, as an example. But the retail investors, this is the point I want to make and get you to respond to it. Their investment doesn't grow in value until the institutions get involved in a big way.
Well, you need the big asset flows, right, to create that sustained growth. And we are seeing right now that the supply of stocks is increasing, right? So if there's more demand for stocks than supply, then stock prices will go up. If there's more, supply than demand, stocks will go down. And we are starting to see more selling from institutions. Retailers are kind of buying it up, but the pace at which it comes in, if there's still not a lot of people there kind of selling, prices can go up pretty rapidly, right? And so you see a lot of kind of market orders, people sit and buy, right? And all of a sudden the prices can move up, and that's why you get a lot of this volatility, because it's indiscriminate buying and selling.
I'm just trying to make the point, and this is what I want to make sure our folks understand, is that on a day where the Dow lost nearly 2,000 points, we had the biggest inflow into equities from retail investors. They didn't move the needle in a positive way.
They're not going to. Now, I think they came in on Monday, and there was more, and that drove it up, right?
Helped.
But retail investors, if there's more institution selling, you're not big enough to move the needle.
Right.
But in a more normal market, if there's not a flood of institutional selling, they can drive the market higher.
Okay, that makes sense. I mean, if they're coming in and institutions are staying putting holds out,
it's all supply demand.
Yeah.
Right. I mean, and so it all depends on, again, if retail investors are flooding in as institutions are just hammering it and selling it, they're not going to make up the difference.
Yeah.
But if the institutions are kind of calm, like probably today, then you're going to see retailers driving the market up.
Okay. So we have seen the 10-year yield actually fell below 4% late last week, but it's up above.
But now it's popped up, right?
Yeah.
And so I find this kind of interesting, because one of the things that's out there is, well, the administration is trying to drive interest rates down. They're trying to force the Fed's hand to cut interest rates because they want to refinance the debt, right? Well, all of a sudden you have a 20 basis point jump back up in the 10-year. Well, that's defeating the purpose, right?
Yeah.
And so I think that's why right now I would tell people, one, you should be properly allocated. You shouldn't be panic selling here, right? But if you are trying to trade this, I would say have a little bit of caution here, because there's a good chance there's a retest. I know Jeffrey Gundlach was on CNBC, I think it was yesterday, talking about 4,500 is kind of where he sees it going. The big thing is, generally speaking, in these waterfall declines, you're going to get a retest. Now, last couple times, 2018, 2020, we didn't see that. I think those were slightly different fact sets, right? Because number one, in 2018, the Fed acted.
True.
2020, the government just flooded the market with money, right? And so does that happen in this case?
Yeah. Let's talk about fiscal policy, because we got the House and Senate that are trying to get together and get a budget resolution passed. And, of course, the main component of that is the Trump tax cuts, the 2017 tax cuts. They're trying to either extend those or, better yet, make them permanent. But they don't seem to be on the same page just yet. Do you think the markets are waiting to see what happens there? And could we get a bounce if we get a deal?
I think that would obviously be good. I think the market is still discounting that they're going to get something done that's going to look a lot like renewing the 2017 bill.
Yeah.
The longer it drags on, right, the worse it gets. And, all of a sudden people want other things. Maybe these tariffs become a part of it. Like, hey, if we're going to do this, we got to cut back on the tariffs. And now all of a sudden you've got this issue between the president and Congress. So I think the market is still expecting that we're going to get a tax bill done.
Okay.
But it's dragging out for sure. And again, yes, Republicans have control, but it's it's still relatively. It's not a super majority, right? I mean, it's still pretty tight. It only takes a couple dissenters, and all of a sudden, you can't get anything done.
I think if everybody is seated, I read this morning, in the House, could lose 4.
Yeah.
You could have 4 based on the balance there. So we'll see. But right now, there doesn't appear to be consensus between the two chambers, certainly on the Senate bill that just got sent over to the House. There's a number of members of the House that are balking at that.
Yeah.
So mainly overspending, because they had like a floor of $4 billion over 10 years. Are they kidding me? That's like an hour of spending.
That's nothing. That's nothing. So, like I said, I think for all of our listeners, the number one thing here is, be patient, be diversified. Markets go through their ups and their downs. Just take a chill pill, let it kind of settle out, and
Makes
then adjust.
sense. Jeremy Nelson, partner at Element Wealth, has been our guest. Thanks for coming in, Jeremy. Appreciate it.
Appreciate it.
We're coming right back. Stay with us.